Hello, and thank you for tuning into this month's webinar titled, Is a Red Hot January a Prelude to a Big Year for Equities? My name is Andrew Taylor. I'm an investment manager and part of the wealth management team here at OJM. The topics that we're going to cover today are wealth management outlook for 2013. I'll discuss some of the catalysts that we feel that could be a positive contributor to the market, some of the hazards that we may experience in 2013, and an update on the federal debt ceiling. My goal today is to cover the material in 20 minutes or less, so we're not going to keep you here for an extended period of time. I do need to start with our standard investment disclaimer, and the key takeaway here is that we are performing some forecasting. The outlook is based on what we feel is most likely to transpire according to the key indicators that our wealth management team follows and the data that's available to us at this point in time. Conditions can certainly change. However, we do feel very good about the research and the work that we have performed. So for those of you who are listening that are not current clients, OJM is a comprehensive financial planning firm providing a variety of services to our existing clients. We have a very diverse set of skills and talent on staff that has expertise in a wide range of areas, as you can see some of the subject matters in which we deal with listed here. I think the greatest part of working for OJM is the fact that we have access to a tremendous amount of resources in-house. I can walk across the hall and speak with our tax expert. We have a legal expert on staff. We have an owner who has a tremendous amount of experience and specializes in business and entity structure. And that's really a tremendous value, I think. Most of the questions a client would ask us, we could more often than not provide an immediate response and an answer just with the individuals that we have here at OJM. We do have books available. As you can see, these are free to anyone listening to the webinar. As you can see, we have developed a niche for physicians, but we do not work exclusively with doctors. Not pictured here is a book entitled Wealth Secrets of the Affluent. If you are interested in a copy of one of these books, please let us know. A minute on the wealth management team at OJM. Our focus is on managing risk, and this is the core topic in most of our meetings and the regular discussions that our wealth management team has. We're always looking for new and creative ways to implement risk management strategies in our clients' portfolio. What we utilize is an institutional approach to managing money, and we attempt to deliver that to individual investors, and I think we do a great job of that. And probably the best real-life example that really indicates why we have the thought process that we do, if you look at what happened with the S&P 500 from October of 2007 to March of 2009, the S&P lost over 50% of its value. To recover that type of loss, you'd need 100% return to get back to your break-even point. Like in comparison, if you experience a 10% loss in a portfolio, it only takes an 11% return to recover that to return to your initial investment. So minimizing volatility is critical, and that's a philosophy that we believe in very strongly. So let's get right to it. I'm going to immediately give away our investment outlook, so I hope that you tune in, stay tuned in for some of the reporting data and our rationale behind the thought process. But we do expect that we will see either historical average equity returns, possibly slightly below historical returns for the calendar year 2013. We do anticipate housing will be a significant catalyst and a positive contributor. The policy of easy money is very likely to continue throughout 2013, so the Fed is unlikely to begin tightening in any significant manner. We do expect inflation will continue to be moderate. Bond buying programs should continue at least through the middle of the year. The Fed's currently purchasing $85 billion of bonds per month in the form of treasuries and mortgage-backed securities. And then we do anticipate some significant cuts in fiscal spending, and that the increased taxes will also serve as a drag on the economy. So I think those are likely to be the biggest detractors that we're going to be facing in 2013. But let's begin with the catalyst and the reason for optimism. And again, to go back to the title of our presentation, we had a huge month in January. The S&P posted its best return since January, since 1997. We finished the month less than 5% off the highs from October 2007. Finished the month up 5.2%. The S&P's more than doubled since the lows of March 2009. This was the best start for the Dow since 1994. Back to the S&P, we're approaching the record high, which was 1565. We also are seeing a tremendous amount of inflows into equities. January was the largest inflow since before the financial crisis occurred. You've heard a tremendous amount of coverage from the media in regards to the great migration from bonds. The fact is that's not necessarily true. Bonds experience positive mutual fund inflows for the month, so most of those dollars that are going into the market are coming from cash. There's still a tremendous amount of that cash on the sidelines, which could certainly fuel the market even higher the remainder of the year. Corporate fundamental risk is very low, and this may be surprising to a few of you to hear that statement, because we have seen valuations begin to become somewhat extended. However, a deeper dive into those balance sheets, there's a tremendous amount of cash. Companies have continued to increase their dividends. I mean, dividends have simply been soaring with this last round of earnings season. And there is plenty of room for increases. Dividend payout ratios still are at historical low levels, so we would not be surprised to see those dividends continue to move upward. We are also at historical low net debt to shareholder equity. What that means is companies certainly have more capacity to borrow. They're not taking advantage of the low cost of borrowing and the low interest rates. Debt can actually be used to enhance return on equity, which is a positive for shareholders and investors. Back to that low cost of borrowing, IBM recently issued 5-year bonds for 1.25%. So those of you who are business owners, if you ask yourself, if you were able to borrow money at 2%, do you think you could have a positive return with that type of rate? Most of you, I would assume, would answer yes. So you have to feel confident about the ability of most companies to generate a profit through the use of debt, as long as it's not excessive, which it certainly is not. So all of these factors above lead us to believe that it's not likely that we will see a sell-off of any significance. Well, we certainly could see some form of a short-term pullback, given the levels that the market is currently experiencing, as well as the upcoming sequestration, which we'll get into towards the end of the presentation. We feel like that a lot of these positive fundamentals provide a floor for the markets. So our chief catalyst is housing. I mean, the recovery is real. There's a load of data to support this trend. Certainly not going to quote all of it today, but a few of the key numbers you see in front of you. Home prices were up over 8% in December, year over year through the end of 2012. This is the largest increase since May of 2006, and December marked the 10th consecutive monthly increase in prices nationally. Another positive development, if we jump ahead to this chart, what you're looking at here is new housing starts. So for roughly 5 years, I mean, at the peak of the recession, we essentially built almost no new homes in the United States. Well, what this did is, this eliminated a lot of the excess supply, and obviously home prices are a function of supply and demand. Our excess supply now, as you see, is slightly over 4 months, and that's the lowest that number has been since 2005. So that certainly has the potential to push home prices even higher. Some other positive factors: the low cost of borrowing. This makes Housing, very, very affordable. We are also seeing consumers aggressively refinance their homes. This would reduce monthly outflows, obviously. They're shortening the terms of their loans. In many cases, even seeing their payment go down with a shorter term. 30-year fixed rate is in the ballpark of 3.5% right now, certainly well below historical averages. And finally, don't underestimate the psychological impact of increasing home prices on consumption. There have been multiple studies that have shown that one's perception of their own wealth is actually closely tied to the value of your home. It doesn't sound like the most logical approach for making financial decisions, but there is plenty of data that supports this. Increasing home values simply make consumers more likely to spend. And keep in mind, consumer spending makes up 2/3 of the economy, so this can be a key factor. Some other catalysts, inflation does remain contained. The CPI, and I'll show you a quick chart on this, came in at 2.1%. That's core CPI in December, which is simply a measure of inflation, minus the volatile food and energy. Labor costs are very contained, which is probably the key driver of inflation. There's still plenty of excess capacity to produce more goods, and the velocity of money remains very low. All those are factors that would typically drive inflation, so they are not problems where we see this getting out of hand, at least this calendar year. The Fed will likely continue to keep the federal funds rate near zero. I mean, their target is to remain accommodative. In other words, provide easy money until unemployment drops to 6.5% or inflation reaches 3%. Now, right now, unemployment's at 7.9%. If we see 6.5% unemployment, that means the market will have more than likely had quite a run, and that would certainly, obviously, be positive for equity. So we don't feel that an increase in the federal funds rate is a very likely scenario anytime in the near future. QE3, the bond purchase program that the Fed has implemented, there are whispers that will come to an end at some point this year. We don't necessarily believe that that's going to happen before the middle of the year, and they do want to see significant economic growth before they turn off that purchase program. And the other point worth mentioning, this is more from a global perspective, the European Central Bank has stated that they will step in and aggressively purchase bonds if need be, if there is some support that would be needed. But this is likely surprising to most of you, but data released by the IMF states that most Eurozone countries do expect to show a surplus in 2013. Again, probably not information that most of us expected to hear. So not everything is rosy. So what are the potential hazards? What are the things that we're looking out for, or what concerns the wealth management team here at OJM? You've heard all about taxes, increasing the income taxes, the top rates, the capital gains, the top rate jumping from 15 to 20%. You factor in the Medicare tax, you add another 3/8 to that. So those clearly are going to be a drag on the economy. One increase that has just recently gotten a little more media coverage was the payroll tax increase. For someone making $100,000, that's an extra $2,100, obviously, in taxes that they did not have to pay last year. And another large factor here, these top 20% of earners account for roughly 40% of total consumption. Well, I made the comment that 2/3 of the economy is driven by consumer spending. Well, if you continue to raise taxes on those that are the largest contributor to spending into economic growth, you really run the risk of hampering, growth overall as a country. So it is one concern that we do have, and it's something that we're monitoring closely. Gross domestic product in the fourth quarter, you may have heard that report indicated that we actually had negative growth. Now, most economists will tell you they expect a revision to that number. It's not unusual to see revisions after the data is released, and we certainly expect that will take place and show positive growth. The biggest detractor in terms of growth was the cut in fiscal spending. We'll get to that in a second. Contrarian sentiment, and this is Sentiment indicators are increasing, and this is an awful analogy, but the dumb money confidence is certainly rising. There is plenty of data to show that is a fairly reliable leading indicator. So what that tells us is that there is the possibility of a short-term pullback. Simply increases the likelihood, doesn't necessarily make it inevitable, but it's something that we'll be watching out for. And then the cuts in fiscal spending, which I had touched on. There's no question that we will see some form of cuts as we approach the sequester deadline of March 1st. And avoiding the task of balancing the budget is certainly not an option. It's something that we're going to have to do. So I'll spend a minute talking about the federal debt, or a few minutes, excuse me. Most of you have probably seen this chart, and it's a perfect illustration of why inaction is certainly not an option with where we're headed. The two biggest concerns that we are focused on, the growth of the entitlement spending, and that's simply a factor of our country's demographic trends in the aging population, and the fact that at some point in time we are going to see interest rates rise, and when that happens, that's going to become a larger and larger component of our federal outlays. Well, interest rates will rise unless we become Japan, and let's certainly hope that isn't the case. I felt this chart is useful just to simply demonstrate the impact that interest will have. And again, this is interest on our federal debt, what this will look like in terms of a percentage of our budget relative to GDP. So the numbers are fairly astronomical. Again, we do need to take some steps to get our financial house in order. I think this slide demonstrates the risk of sitting in cash. So there are some headlines out there that may cause the average investor to be concerned, and we have seen a tremendous amount of media coverage about the sequester cuts. If we do reach an agreement that inspires confidence, there's a very real chance that the markets could take off. And the best recent example of this exact type of situation, we certainly remember all the concerns about the fiscal cliff and the dramatic increase in taxes the end of that we were faced with the end of 2012. Well, if you actually look at the performance of the S&P from November the 15th to February the 15th, it was up 12%. A very large number of investors were on the sidelines because of the concerns about the fiscal cliff. Details on the cuts that are scheduled to take place on March 1st, if there is not some type of an agreement. The sequester cuts were actually never intended to be enacted. The worst part about the sequester is that they are across-the-board cuts, and they're not targeted necessarily in the areas of need. Someone would never run a business this way, which is why the sequester is viewed as a negative if it were permitted to occur, which is why there are aggressive negotiations to see that it does not. It's easy to get frustrated at the government's inability to act. However, these are some facts from a fairly well-known website, fixthedebt.org, which Alan Simpson and Erskine Bowles have made famous. This just shows how difficult it is to find a solution to our current fiscal issues. Each party certainly has some valid arguments. Regardless of which side of the fence you find yourself standing, I think you would probably acknowledge that we are facing a very difficult set of circumstances here to balance the budget. You can't simply focus on spending cuts exclusively. It would require cutting all spending by a third. That would almost certainly send us into a recession if we implemented that immediately. We can't tax our way out. That second bullet point, if we tax families making over a $250,000, the top rate would have to exceed 100%. And finally, we can't necessarily grow our way out without some form of cuts. Faster growth means higher tax revenue. However, you also would see an increase in cost and entitlement. So we need a combination of each of these in each of these areas to find a more comprehensive solution. There is some hope. We believe that some form of a deal will be reached. Whether or not it happens on March 1st, it's difficult to say, but we do feel like that we will avoid sequestration as it's currently scheduled to occur. The reality is by the time you hear this recording, we may already have a deal in place, so I'm not going to spend a tremendous amount of time diving into additional details. That wraps up our content for today. So I do want to thank you very much for tuning in. Again, I will reiterate that if you are not a client and you would like a copy of one of our books, please reach out to us. If you are a client and have any questions about the material we covered in this webinar, please reach out to your advisor. We look forward to working with you, and thank you once again for your time today.